Hey everyone, welcome to Professor FinTech. Quick question. Have you ever opened your bank app, looked at your balance and thought, wait, that doesn't look right? Maybe your cash book or your accounting record show one number, but your bank statement shows something completely different and you are sitting there thinking which one is correct? Who is lying to me? Well, welcome to the world of bank reconciliation, the process that solves this mystery every single time. In this video, we are going to break it down from absolute zero, no accounting degree required by the end. You will not only understand what a bank reconciliation statement is, you will actually know how to do one. Let's get into it. Here's our roadmap for today. First, we will tell the story of a bank reconciliation, what it is and why it exists. Then we will dig into why the numbers are different in the first place. Spoiler, it's usually not fraud, but sometimes it is. After that, we will work through a real step-by-step example of reconciling a cash book balance. Then we will tackle overdrafts, which is where you have spent more than you have and now your records look completely upside down. And finally, we will cover best practices and tools to make this process fast, accurate, and painless. Ready? Let's start with the story. Imagine you run a small business, a bakery. Let's say you keep your own records. Every time money comes in or goes out, you write it down. This is your cash book. On the other side, your bank also keeps a record of every transaction in your account. This is your bank statement. These two records should match, but here's the thing. They almost never match exactly, at least not at any given moment. Here's a simple example. On a Monday, you record a payment of $5,000 from a customer who gave you a check, but the bank doesn't actually process that check until Wednesday. So on a Tuesday, your cash book shows 5,000 more than the bank does. Is someone wrong? Not really. It's just a timing difference. But what if the difference isn't timing? What if your bookkeeper accidentally typed the wrong amount or the bank deducted a fee you didn't know about? That's why we do bank reconciliation. To find these differences, explain every single one of them and make sure our records are telling the truth. A bank reconciliation statement is simply a document that explains why your cash book balance and your bank statement balance are different and proves that the difference can be fully accounted for. Now you might be thinking, okay, so I find the difference. So what? Why does it matter? Let me give you four real reasons. Reason one, verifying accuracy. Meet Ravi. He checked his books and was confident he had a $1 lakh in the bank, but when he finally did a reconciliation, he found the actual balance was 85,000, or 15,000 less he would have issued hadn't been cashed yet, but he had already spent that money in his mind. Without reconciliation, Ravi might have bounced a check. With it, he caught the issue in time. Reason 2, identifying errors. Accounting is human work, which means it's subject to human error. A typo, entering $2,500 as $25,000 throws everything off. Bank reconciliation is like a spell check for your finances. It catches those mistakes before they compound. Reason 3, detecting fraud. This is the serious one. A cashier at a small firm was quietly adding fake expenses, small amounts, hoping they would go unnoticed. Monthly bank reconciliation caught the extra withdrawals within 3 weeks. Without it, who knows how long the fraud would have continued? Reason 4, compliance. Auditors, tax authorities, and investors all want accurate books. A clean, regular bank reconciliation is your proof that the numbers are real. It's not just good practice. In many businesses, it's legally required. Before we dive into solving problems, let's understand what's in a bank reconciliation statement. Think of it like the ingredients you need before you start cooking. First component is opening balance. This is simply where you start. The closing balance from last month becomes this month's opening balance. Straightforward. Component 2, deposits in transit. These are components you have already recorded as received, but the bank hasn't processed yet. Like dropping a check into the mailbox on a Friday afternoon. You know it's sent, but it won't arrive until Monday. Component 3, outstanding checks. These are checks you have written and recorded in your books, but the recipient hasn't deposited them yet. So your bank still shows that money as yours, even though it's effectively gone. Component 4, bank charges and credits. These are fees, interest charges, or direct credits that bank applies to your account. Things like SMS alert fees, loan interest, or automatic transfers that you might not have recorded in your cash book yet. Component 5, errors and corrections. any mistakes, whether made by you or rarely by the bank, that need to be found, documented, and corrected. Every bank reconciliation statement is built from these five ingredients. So we now know what a bank reconciliation is. Now let's understand why discrepancies happen. The four most common culprits are: number one is timing differences. I already mentioned this, but it's the most common. You record a 5,000 customer payment on a Monday. The bank only shows it on a Wednesday. For 2 days, the record will differ, and that's completely normal. It doesn't mean anything is wrong. Number two, unrecorded bank charges. Your bank deducted a $200 of SMS alert fee. You never got a notification. Your book shows more money than the bank. These small fees add up and are surprisingly easy to miss. Number three, recording errors. This is the classic transposition error. You paid 4,500 to a vendor, but accidentally typed $4050. That $450 difference it will haunt your reconciliation until you track it down. The good news is the difference between transposition errors is always divisible by 9. That's a handy trick for finding them. Number four, outstanding checks and deposit. You issued a check for $10,000 on December 20th, but the supplier only deposited it on January 2nd. Your books show the payment. The bank's record don't. Yet this creates a temporary differences that completely legitimate. Most of the time, discrepancies fall into one of these four buckets. Once you know which bucket it's in, you know how to handle it. Alright, let's move from theory to practice. In this section, we are going to look at the most common type of reconciliation. When you have a positive cash book balance, meaning you believe you have a money in the bank and you need to figure out why your number doesn't match the bank's number. Before we solve an example, let's look at the kinds of problem you will actually encounter. Problem number one, omitted transactions. Priya forgot to record a $3,200 refund she received via NFTP. Her passbook was understated by exactly that amount. The fix: compare every bank credit with your records. The bank shows money coming in that isn't in your book. Find out why. Problem 2. Recording errors. A payment of $12,750 was recorded as $12,570. Classic transposition. Just 2 digits swapped. Easy to make, annoying to find. Always double check amounts, especially when numbers look similar. Problem number 3. Unrecognized bank fees. A $350 annual debit card fee appeared in the bank statement but nowhere in the cash book. A silent thief. The fix: check bank notification emails and read the footnotes on your bank statement. Problem 4. Timing differences. A $25,000 of a check paid to a supplier on a Friday appears in your books. The bank processes it on a Tuesday. 3-day gap equals a discrepancy, but it's a legitimate one. Track all in-flight checks and deposits in separate lists. Now here's the actual process, 4 steps that it's gather and compare. Pull out your cash book and your bank statement for the same time period. Go through them the side by side, line by line for every transaction that happens in both. Put a tick mark. These match items are done. You never need to worry about them again. Second, spot the difference. Everything left without a tick is a suspect. Critical them. Now categorize each one. Is it a timing issue, an error, a bank charge you didn't know about? Giving each item a category makes the next step much easier. Step 3. Make adjustments. Here's where the actual reconciliation happens. For items the bank recorded but you didn't, like bank fees, you update your cash book. For items you recorded but the bank didn't, like outstanding checks, you list them separately. You are building a bridge between the two balances. Step 4. Verify and close. After all adjustment, your adjusted cash book balance and your adjusted bank balance should match. If they do, congratulations, you have successfully reconciled. If they don't, you keep hunting. There's a still difference hiding somewhere. Pro tip: do this every month. The longer you wait between reconciliations, the more transactions pile up and the harder it is to find errors. Monthly reconciliation keeps the problem manageable. Let me walk you through a real example. Given your cash book balance is $42,000, bank statement balance is $45,000, 800. They don't match. The difference is $3,800. Why? After investigating, you found 3 things. 1. The bank deducted $300 in charges you didn't record it. This reduces your cash book balance. 2. The bank credited $500 in interest you didn't record it. This increases your cash book balance. 3. A customer made a direct deposit of 4,100 straight into your bank account. You didn't know about it. This increases your cash book balance. So your adjusted cash book balance becomes $42,000 minus $300 plus $500 plus $4,100, which is equals to $46,300. Now let's look at the bank side. You issued a check of $1,500 that the supplier hasn't presented to the bank yet, an outstanding check. So your adjusted bank balance becomes 45,800 minus 1,500, which equals to 44,300. Wait, 46,300 doesn't equal 44,300. You still have a $2,000 of a gap. That means there's something we haven't found yet. Maybe there's a deposit in transit, money recorded in our books but not yet shown in the bank. We keep investigating. In practice, maybe you find that a $2,000 check you received was recorded Monday, but the bank only picked it up on a Wednesday. That's your $2,000. This is the process. You keep digging until every rupee is explained. Now let's talk about something a bit more uncomfortable. What happens when you have spent more than you have? Enter overdraft. And overdraft is when your withdrawals exceed your available balance. In accounting terms, instead of a debit balance in your cash book, you have a credit balance, which is the opposite of a normal. Here's a simple scenario. You have a $5,000 in the bank. You issue a check of $8,000. You are now $3,000 withdrawn. The bank covers it but charges you interest for the privilege. Now, reconciling on overdraft works similarly to the regular cash book, but you have to be extra careful with your signs. A positive and negative mixed up can flip your entire calculation. Common errors in overdraft situation: unrecorded payments. You spent money but forgot to log it, making the overdraft look smaller than it is. Sign confusion. It's easy to accidentally add when you should subtract, or vice versa when you are dealing with the negative balance. Timing. A check clearing while your balance is already negative can cascade quickly. How to resolve overdraft disturbances? Verify every single transaction. Double check the direction in or out as well as the amount. Update your records with any bank side adjustment you missed. If there is an unexplained charge, call the bank. You would be surprised how often a quick conversation resolves a mystery that would have taken hours to diagnose in a spreadsheet. We are almost at the finish line. Let's talk about how to do bank reconciliation well. Best practice number 1: reconcile monthly at minimum. Set a calendar reminder for the 5th of every month. Treat it like paying rent, non-negotiable. Companies that reconcile quarterly tend to spend days fixing what a monthly reviewer would have caught in minutes. Second, go line by line. Never assume two totals match just because they are close. Every entry deserves a tick mark. It's tedious, but it's thorough, and thorough is what protects you. Best practice number 3: use accounting software. Tools like Tally, QuickBooks, or ZoBooks can auto-match transactions and flag discrepancies automatically. What takes hours manually can take minutes with the right tool. Best practice number 4: maintain an audit trail. Document every adjustment you make and write down why you made it. If an auditor or manager questions it 6 months from now, you will thank yourself. Best practice number 5: have a second person review it. Fresh eyes catch what tired eyes miss. Even a 5 minutes review by a colleague can surface errors you have become blind to after staring at the same spreadsheet for an hour. 6. Investigate every difference, even small ones. Even a $10 difference matters. Small unexplained differences are often symptoms of larger problems hiding just underneath the surface. Let's be honest, manual reconciliation is painful. Cross-referencing spreadsheet line by line, hoping you didn't miss anything, typing to remember why you made a note 6 weeks ago. Technology changes all of this. Modern accounting software can connect directly to your bank feed, automatically match transactions, highlight anything that does not match, and even send you alerts when something looks unusual. Instead of spending 3 hours reconciliation manually, you might spend 20 minutes reviewing what the software has already flagged. For small businesses just starting out, even a simple spreadsheet template can dramatically reduce errors, save time as you grow. Investing in cloud accounting software is one of the highest return on investment decisions you can make. The bottom line, technology doesn't replace the need to understand bank reconciliation. You still need to what you are looking at, but it makes the process faster, more accurate, and far less stressful. Alright, let's land the plane. You have just learned one of the most essential concepts in accounting. You now know that a bank reconciliation statement is simply a document that explains why your cash book and your bank statement show different balances and proves that every difference has a legitimate explanation. You know the four key reasons why numbers differ: timing, unrecorded charges, errors, and outstanding items. You know the four-step process: gather, spot, adjust, verify. You understand overdrafts and why they require extra care, and you know the best practices that separate good bookkeepers from great ones. If you are new to accounting, let me leave you the one parting thought. Bank reconciliation isn't just a task, it's a discipline. The businesses that do it consistently, thoroughly, and on time are the ones that have clean books, catch problems early, and earn the trust of auditors, investors, and partners. The ones that skip it, they find out the hard way, usually at the worst possible moment. If this video helped you, please give it a thumbs up. It genuinely helps more people find content like this. Subscribe if you want more accounting concepts explained in a plain English with real examples, and then drop a comment below. What accounting topic would you like us to cover next? Until then, keep those books balanced.